Good morning in Scotland. I hope you've had your coffee and are ready for this quite insightful discussion this morning. Good evening in China, or late afternoon. I understand it's very hot and stormy in Beijing. Quite different temperatures for the summer. I think you're up about 38 degrees in Beijing. We're about 20 degrees lower than that in Scotland, but that's a fine sunny weather for here in Scotland. So my name is Martin Perbrick. I'll moderate the discussion today. With us is Roddy Gow, the chairman and founder of the Asia Scotland Institute, both of us calling in from Edinburgh today. And our focus today is trading with China in the post-COVID world, the opportunities and challenges. Obviously, I think most on everyone's mind in relation to China is the dynamic zero COVID policy, which has been creating quite a deal of uncertainty across the world because of the impact on other economies. It's obviously entirely up to the Chinese government and people how they deal with COVID-19 themselves, but it's interesting that their own approach and policy is having an impact on the economies of other countries, it seems. So most of the world has moved on, I think, largely from the huge loss of life and economic disruption caused by the COVID-19 pandemic, although there's still very high case levels in many countries, including our own here. But there is a pretty relentless fixation on the policy of dynamic zero COVID in China that does seem to be affecting, what I think is pretty clearly affecting supply chains that are reliant upon China. And we'll hear from Jörg Woodker shortly about that subject. So we have two very experienced executives this morning to discuss aspects of what's going to happen with business in China and the economy in China in the coming years after, well, and now, I think, more importantly, after COVID-19. First, Mr. Jörg Woodker, President of the European Chamber of Commerce in China, an office he first held in 2007, he's been doing it for some time. He was also chairman of the German Chamber of Commerce in China, some years, and he's been a member of the advisory board of Germany's leading think tank on China, I would say actually one of the world's leading think tanks on China, Mercator Institute for China Studies in Berlin. He's also vice president with a day job, I think, the vice president and China representative for BASF. And part of that role, he's vice chairman of the International Cooperation Committee representing multinational companies in China's Chemical Association. And as an executive, he's lived and worked in China for something over 35 years, I think, Jörg. So an extraordinary career in that country. And I think one of the people who we should all look to for some insight into what's happening in China and what's likely to happen in the future. Secondly, we have Mr. Yang Du, who's an associate at the Moller Institute, which is at Churchill College, University of Cambridge. Yang has a very strong background in the financial sector. He's a former vice chairman of the Chinese Asset Management Association of Hong Kong, a member of the advisory committee of the Financial Services Development Council in Hong Kong. And he was a managing director of China Securities International Asset Management and chief strategist and head of fixed income asset management at Thomson Reuters for some time. So welcome to both of you. We really have a lot to get through today, but we do have, for the audience's benefit, a bit of an early stop, 5 minutes before the hour, as quite a number of people on the call have to get off to other meetings. So just a quick reminder, we're on the Zoom webinar platform today, so you can't be seen and heard, the panelists can, but we would like to hear from you. So please, could you put your questions in Zoom chat? And we'll look through them and try to get to as many as we can. So with that, Roddy, could I hand over to you, please, to kick off the discussion?
Martin, yes, thank you very much. And many thanks to both Jörg and Yang for being on this call. It's hugely good of you to do that. And really to help piece together the emerging situation and the opportunities and challenges presented. I would like to ask Jörg if he could kick us off by, there were three things I think he would like to speak about: China's current direction in terms of ease of doing business, their zero COVID policy and how that's working, and the issues, if he has time, of carbon neutrality and energy transition. So Jörg, it was very different the last time we spoke, and you spoke to the Institute. We were full of optimism and China was growing like gangbusters. But now we're in a very different place as a world, and your views on that would be enormously appreciated. So over to you.
Well, thank you very much, Roddy, and thanks for the introduction, Martin. It's a great pleasure, despite the fact that, of course, I rather do it in your region with a good whiskey ending than the session. First of all, the Chamber has 9 offices across China. We have 1,800 members, and we just launched a survey on Monday, which you can download free of charge, and you don't have to be a member from the European Chamber website. The interesting thing is that we did this a survey in February. After, of course, we had it evaluated, it was, of course, very positive. It was extremely optimistic, forward-looking. 2021 was a very good year for most of our European companies. And then, of course, when we were about to launch it, the 2 black swan events happened, lockdown in Shanghai, as well as Putin attacking Ukraine. So we had to do a flash survey in order to rectify this, get a bit of a reality check in there. So we have a bit of a Jekyll and Hyde survey, which we launched on Monday. We have clearly the base load. European business is sticking to China. We have a situation where we do not let our people go, but a quarter of our members say they are considering to put new money, new projects into other countries. That's a totally new dimension that we see. And it is all about this nearshoring, friendshoring, this supply chain situations, and the fact that China looks very different now. I think within a very short period of time, China, in particular, its best city, Shanghai, has managed to actually lose its allure and has caused headquarters to reconsider what to do about it. Of course, China's stance on Ukraine is another one, this kind of fence sitting, which offends many Europeans, and it simply cannot be grasped here. People don't understand why Europeans are so upset about it. Well, you know, we have a war at our borders. We have 5 million refugees in our countries. We have someone fiddling with nuclear weapons. And of course, that has changed everything for the Europeans, something that China simply doesn't recognize. Well, again, business outlook is very different now. COVID is a game changer, and in particular, China stands on zero tolerance. Zero tolerance means nothing else but hoping that the world gets rid of Omicron and then China opens up again. China was very strong 2 years, zero COVID, had an incredible run, and possibly that was the undoing of their success story, because they will believe that they can continue like this. But the mutant is just a very different animal that is very contagious and so forth. So what we're having now is a situation where China is basically COVID naive. They have no herd immunity. They have very weak vaccinations. They had an incredible positive run early in 2021 with 30 million vaccines injections every day, 30 million. And now we're down to 1.5. In my age group, 60 and above, China used to have 1 million a day, and now it's 100 to 200,000. So it's amazing to see that China's solution lies in vaccination in order to then open up, and China decides to actually maintain rigid, draconian lockdown measures in order to keep the figures very, very low, while the world is basically recuperating. And even though they have many, many cases, as they're well vaccinated, it doesn't matter in most cases. Like in my own family, my daughter-in-law had it 3 times, my son twice, and my daughter had it once, and they're all fine. In China, it is terror if you have COVID. So in a way, that of course leads many companies to reconsider what to do in China. European companies, I wrote a letter to Vice Premier Hu Zhonghua saying that this has to change, because otherwise we change our China story. I said there had to be a different vaccination policy, meaning it has to be mRNA. BA4 and BA5 are coming up in fall, in summer this year. China's totally unprepared for that. So in essence, what we are learning now is that lockdown will continue. We have a whack-a-mole approach, meaning any city can go down in no time. A district, it's extremely disruptive. We always have the worry that it's going to happen to us. We still have borders closed, so we don't have our executives coming in. And even more important, we don't have Chinese decision makers visiting Europe anymore. These were very important people for us to have Chinese investment in Europe, as well as Chinese politicians. visiting our capitals in order to get the better grasp of what actually our decision makers are thinking. This whole online thing is distorting. I had the honor of meeting Prime Minister Li Keqiang about 10 days ago, and exactly that's what I said to him. And it resonated with him very strongly. He said, we lost our human touch connections with Europe, and we really have to do something about it. And he said, we have to also get a better balance of vaccination policy and economic policy. And interesting enough, that part was cut out in the official announcement of our meeting. So in a way, there are enough people worried in the State Council that they recognize that China cannot open, because that would be irresponsible at this stage. It would have huge implications. The health system would be overburdened, but they don't prepare themselves for it. So my personal guess is that China at best, when they get mRNA, when they do the vaccination again, can open up to the world sometime in summer in 2023. Until then, China will have vanished from the radar screen and will do its own thing, and we have to live around it. That has, of course, huge ramifications, because now our executives are happily traveling to Jakarta, Singapore, in India, or even in other regions. And these politicians are visiting our headquarters and doing the lap dance in order to get our executives' attention. And of course, that will matter. So can we wait another year for a project? I don't think so. Can we actually put up a shop in Malaysia or in Jakarta and then send into China? Of course we can. It's RCEP that makes it more easier for us. So in a way, the kind of uniqueness of China, that it's the only place where we put our money, has virtually gone. But China can recuperate from this one. China has the best clusters, the best supply chain, a huge pool of engineers. China has everything going its way, but it has, for the time being, chosen to be basically punching below its weight. We are working on a new paper for the government, and the theme for me will be that China became unpredictable. China has been incredibly predictable in the past. It was always geared towards the economy. It was very rational, but now we have such an overload of ideology that it makes it very hard to understand what's the next step going to be. We had a very strong fight against the IT companies last year that has basically wiped away 1.6 trillion US dollars of market capitalization in the likes of Tencent and Alibaba and others. That has frustrated venture capitalists to a large extent. And these are the guys that actually got China to the economic forefront that we have witnessed over the last years. So in a way, it is a real puzzle of what we see. We see, for example, incredible strong regulatory constraints coming up that leads us companies to consider decoupling, at least on the IT system side, as well as that, of course, we reconsider to do research in China because of the data transfer law. That doesn't mean we drop R&D. No, we emphasize D. We have to do D because China has incredibly good demanding customers in the car industry everywhere. Chinese customers are not loyal, brand loyal, but actually they are very savvy in new gadgets. We learned from that. European business has learned a lot from China. So in a way, if China actually turns its back to the world, it's also our loss that we actually cannot do as much as we wish to do. So we have another paper coming out, or we did actually come out 2 weeks ago, on carbon neutrality. Another topic where I think we have a lot of things in common, where China is 25% of global emissions, China burns 50% of global coal, and Europe has the solutions for it. The European companies have gone already a long way down the road. And that's also what I tell European politicians. We cannot and we should not decouple from China, because we should work with China in order to get a grip on the climate change situation, as China is really lacking behind. China has been actually not very successful so far. They have set very strong targets, 2030, 2060, and our members are very optimistic they will reach it. But the last 12 months, in particular after a very difficult late summer with an energy crisis, has basically led to the rejuvenation of coal-fired power stations. Now that is a new decision-making mechanism for us as European companies, because many of us have pledged carbon neutrality until 2030, 2040, 2060, And of course, the fact that there will be more coal in the electricity system of China makes our pledge not feasible. So we have companies now looking at other regions in order to see if they can get better electricity conditions, green electricity in other places. So in a way, again, it is one of these constraints where China could do more and benefit from it more, but they find it very difficult because they dropped the ball to some extent on the carbon neutrality issue, on the coal issue. So all in all, I think for all of us, we need China to succeed. We need China to actually manage to get back on track. We need a strong vaccination. We need a strong opening up of the market. Because as a matter of fact, if China continues down this road for another year or so, it will be very difficult to be as appealing as it was for 2 decades or 3 decades. And I'll stop here.
Jörg, I think you've actually started talking about what one of our future events. We're going to be talking in probably October about the issue of decoupling and what it means. And I think you got onto that there because it's an extremely important subject. I think especially grateful to hear you talk about the carbon impact of industry in China, and particularly the reliance on coal, and what you said European companies and European governments can do to help that. Because I find our discussions in Europe about net zero targets are meaningless for impact on climate change unless we bring China and India with us with the technology to help them reduce their carbon usage, especially for coal. So this issue of decoupling is a fool's errand, I think, because we really need China and India as collaborative partners in certain things to achieve our own targets. So perhaps we could come back to you on a few of those points later, but I'd like to jump across to Yang now, if we could, with something else you touched on as well, which is the issue of regulation and what that means, because there are such a lot of factors impacting the economy in China and in turn impacting the economies of other countries. So Yang, perhaps with your background in the financial sector, could you talk a little bit about what you see as happening during COVID-19 and what's going to happen after COVID-19? I hope there is an after COVID-19 in China, in light of what's happened in the regulatory area in China. So just as background for the whole webinar, in 2021, the State Administration for Market Regulation took some very aggressive measures that we've all read about, I think, including a $2.8 billion fine on Alibaba and a $530 million fine on Meituan. So what do you think that means for the outlook for the domestic financial sector in China in the near future? Do you think those were one-off measures, or do you think there's a trend developing of greater regulation? Just your broad views on the outlook would be much appreciated.
Thanks. It is a very interesting question. Actually, the nature of Alibaba and Meituan doesn't appear to be a financial player to me, but you touched the points that, why regulators put measures over them. So let's retrieve the authentic story, first of all, just to understand the matter itself. So Alibaba started from operating an online e-commerce platform. Meituan operates as a delivery business. So both of them has expanded beyond the core of their business focus and has ambition to step into the financial target. However, the fund itself was not announced towards its ambition to expand the business into other area, but it is actually for the antitrust behavior that both of the business will tend to restrict the freedom of choice of the customers and the operators, the business owners, especially the SMEs who's trying to sell their stuff on their platform. So that was the causation of this sanction. Comparatively, well, I think it's okay because it's only 4% of the overall revenue of Alibaba, for example, in 2019, as the size of their penalty. If we compare that to the Dutch penalty over Apple, which is 25 million, compared to the overall income, which is the $95 billion, I think European regulators really scratching the surface. If you punish someone, punish fairly. So that's the Asian value, first of all. I think the lesson is great here. If we try to understand why Alibaba and Meituan should put together and really confront what their ambition is. I think the stock market gave us a really good answer, because on the day following that penalty, both US and Hong Kong stock market saw a price rise of Alibaba, for example. So they actually obtained a lot of benefit from the investors' perspective. I think that is a remix of feeling. First of all, investors like to see these type of a big tech company to actually get regulated. And that really eased off some of the investors' concern about what they actually try to do. As Alibaba, with the Ant group underneath, are they trying to be still an online e-commerce operator, or do they want to become a virtual bank and run into the competition against some state-owned big financial giants, for example, like ICBC or Bank of China, et cetera, et cetera? I think we have seen enough cases in Europe and the US. Some of those successful business, tend to be over-ambitious. And I think, as long as you tend to open those business in a new area, you've got to follow whatever FCA or SEC to say in that designated sector. I think that is the principle. Let's not to forget about that. So the pros, there is a pros to Alibaba and Meituan, for example, because what Alibaba trying to create is a loop of consumption. So let's say as a consumer, I buy stuff on Taobao, but I'm running out of my salary. What I can get easily is the virtual credit card, which is called a jiebei. So that means let's borrow. Literally, that means let's borrow. And in case I need more fund, they have another financial facility called Huabei. Literally, that translates into let's expand it. So to European regulator, I think it's insane. We shouldn't allow the random retail buyers to access to financial products so randomly without proper assessment of the risk preference. So in my industry, it is rare to see, and I think it is ought to be regulated. But to the institutional investors in the stock market or in the bonds markets, it appears even bigger risk. First of all, it really confuses us about the authentic health condition of this firm as Alibaba itself. There are three standards, simple standards to evaluate any business in the world, the same way we look at Daimler or McDonald's. First of all, is the scale of the assets, how much assets that company actually owns. So clearly this e-commerce platform doesn't have to carry so much assets. And then the second standard is really about cash flow. How much money they go through. What about the revenue? Are they equipped with enough deal to transact? So that proves the healthy business circulation of the business. And secondly, as a profitability. So those three standards really gives us, as an investor, representative of the investor, to really look into how they would perform in the stock market with a untransparent or opaque behavior around the financial and the liquidity really gives us a confusion to understand what Alibaba is. Is this the authentic profitability that Alibaba actually earns? Do they deserve so? Or it is actually the part of liquidity they get from the people whomever putting some, for example, 10 quid, $15 when they left in their electronic wallet after procurement, and then eventually build up as a part of the liquidity of the group. That gives us a big question mark. As a matter of fact, that was one point that PBOC, the Central Bank of China, really penalized them for. So I think these penalty was quite useful for us to actually think about, we are all entrepreneurs. Once you started your career, like Jack Ma, we congratulate them, but we have to hold our horse as well in the same time to really understand, to not go too far into some area which is not belongs to your expertise. But if you're ambitious to step in, do as professional does. You have got to pass all these examinations and obey as one of the licensed financial professional. I'm licensed in different countries with different criteria. I have to even do different degrees in that sector. I do not envisage anyone to participate without proving their capacity. But actually, what we started from give us a lot more to think about. One part related to today's conversation is most of the foreign firms who set up the business or branches, rep office in China do not appear as secondary market securitized assets to us to invest. They're very rare for them to actually present their business plan as a part of the PE or VC subject to us to participate. I think that is really something for the international business owners to think about. Once you tend to enter a new market, would you stop at really just launching your China entry strategy, or would you be committed to actually take one more step further to actually localize your business in China? I think that is a critical question for us to understand. With all the concerns and uncertainties, especially, what COVID presented to us, I think we are very much on the same page, because without the real economy, without those business performance, we cannot deliver the performance to our investors neither. But, the question around supply chain, would the business owners and entrepreneurs to launch China plus one or China plus N strategy going forward? We can discuss about it, but I think most of the business owners or executives not yet ready to articulate their vision and the strategy. What are they going to do? Especially with the external environment, the tension created nowadays, and there's a lot of blames. Personally, I do not believe in blames. I do not think the geopolitics should play a stronger role in the business world because we are all very rational people here. However, it does create a lot of difficulties to us. Do we tend to have two supply chains if I'm running the global business, or do I tend to withdraw from certain markets so easily? Then where's my commitment to that market? I think it really helps me to answer when I'm allocating my capital around certain really big names. For example, we used to have a joke, when we invest in some German name, part of their China market risk actually got digested through its allocation towards the ETF, which is a passive investment. That actually means this company has no commitment involved into the direct participation into Chinese market, and how can I present that return to my investors? I cannot just confront that and approve it's a rational decision. So I will stop here and to leave something for us to discuss. I think my ending note here is, Alibaba, the big tech, is something really excites the Chinese people because a lot of the Chinese entrepreneurs like to take technology and innovation as a shortcut, fight for the market share. I think that it's approved a new sign in Asia, especially, not just the China, but Indonesia, Singapore, all carries the same trend as well. I think it will be fundamentally different from what we see in Europe and the US. That's absolutely changing landscape from the investment perspective. Secondly, I think the social funding ought to be broadened, from the conventional banking industry. We have to take care of SME and the new economy's demand from our angle as well. I think there's a social duty from financial industry as well. I will stop here and welcome more questions.
Yang, thank you very much. I think really intelligent comments there. In particular, the insight into the regulatory action in 2021, which I think could be better reported by the Western media. Actually, I think they confuse it with political action too often. And I do agree with you. I think detaching political rhetoric from business is extremely important. Unfortunately, I think the other important factor for business is predictability, reliability, and an appropriate prediction and management of risk. And both politically and economically, that seems rather difficult in China at the moment. But in relation to geopolitical relations and, as Jörg mentioned, the COVID policy, I think it's that uncertainty that probably presents greater challenges for Western businesses to make that commitment at the moment. But I think it's a very good point to understand in Western businesses that a commitment is expected for the long term in China. Perhaps if we could go back to Jörg. Jörg, I'd just like to ask about a bit of a broader question on the relationship with China economically. We won't touch on, I think, any political issues at all today. And I noticed some comments from you in Deutsche Welle recently on the trade relationship between Germany and China and the wider European relationship. And you mentioned that that China depends on the European market more than Europe does on China. So Europe exports goods to China of about 600 million euros every day, but China exports about 1.3 billion euros worth of goods to Europe. I think we all know these trade imbalances have existed for some years, and they're complex. They're largely in goods, but not in services. Services are quite different. I think if I could just mention the UK example, in 2019, the UK had a small surplus with China on trade in services. We're obviously a service-based economy. I'm not sure if we manufacture much of anything, frankly, anymore in the UK, but that's another matter. The imports from China were valued at 49 billion pounds. So we have an overall trade deficit of 18.3 billion pounds with China. So I think Europe, UK, we have these trade imbalances. Are these problematic for the relationship, the trading relationship and the business relationship? Do we need on a macro level to correct in some way the trade imbalances, or can they go on in the same way they have for the past decade? I'd just like your general views on that coming out of the pandemic.
Well, you're right. The export market for Europe, meaning the market China, is very small. About 10 years ago, the European Union exported more goods into Switzerland than into the Chinese market. And still, I think last year, the European Union exported 40% more of goods into Britain than they did into China. Just look at the different size of the marketplace. By the way, in my office building, there are lots of mini cars made in Britain. So there's something that definitely is, and the Jaguar is appealing to the Chinese besides the Rolls-Royce. So you build great cars, by the way.
Sorry, do you mean the BMW Mini, I think?
Well, I say, yeah, it's yes. In the BMW headquarters. That's where my office is. So no, I mean, Mini is extremely popular over here. Great, and it's clearly branded as a British product, not as a Bavarian. So yeah, but the trade imbalance is in as far a problem, not because China's exporting so well. Europeans like Chinese products. They are quality-wise very good. They're inexpensive. They are great features. So I wouldn't challenge the export data from China. It's just the import data of China is appalling. Meaning we produce every year this position paper, 400 pages on where the problems are. And this is conducted by European businesses actually in China. As a matter of fact, since 3 years, we haven't seen a single European company setting up shop here newly. It's only those that have been here for a while already, which indicates that many exporters, many people view China as too difficult and actually focus on other markets. The same for 16+1. Eastern European companies were so happy about 16+1, but the impact, it was absolutely zero because China was proposing infrastructure and the Eastern Europeans wanted to export vegetables and grain and fruits and didn't go anywhere. We still have a huge problem with agriculture goods going into this market here. So in a way, the trading data recently about the last 6 to 9 months show that exports from China into the European Union is growing on average year on year, depending on the months, 20 to 30%. And Europeans are around 0, 0.5, -3, -1, and so on. So actually, as a matter of fact, we are selling as much as we did last year, whereas China is really successful. There is something about the market opening mechanism that is failing over here. And of course, we always hear China is opening up. We call it promise fatigue. But it's a real problem. Of course, it's very different when we talk about investment in China. That's where European companies are strong. That's where we are successful, and that's where we actually are remitting a lot of dividends back home, stabilizing our headquarters. But that's not really trade. That's producing in China for China. And hence, there also China does cherry picking. We have issues. So in a way, is that sustainable? Well, for China to sell into Europe, sure, because we're open, we're not going to change this, hopefully. But for China to actually give less choice and less articles for its customers, for its people here, is very questionable. Now, we have this always as a political thing, but I guess that Europe will not go down the road of the US installing trade tariffs, as Trump has proven that trade tariffs actually distort it further and doesn't help really.
Jörg, I think we're talking about some interesting points about the opening up of China. I mean, obviously, the opening up of China economically has been taking place since about 1979. So it's a process rather than an event, I think, and it's gone through different phases. And it is clearly a phase that's a troubling one, not least because we have this extraordinary pandemic, which has caused such disruption and loss of life. So in terms of opening up, Yang, if we could cut back to you, how do you see China coming through the pandemic? Perhaps not on, we won't go into the wider trading issues because I think that's more in relation to Jörg's expertise, but financial services, for example, banking, financial services, investment. How do you see companies in China, investors in China seeking to come out of the pandemic, given the problems you have at the moment that we've been through already with vaccine efficacy, vaccinations in the older part of the population, and the extent of public health care in China? How are financial services firms going to pull out of this, do you think?
Yes, actually, that was the same question I replied to Financial Times a few days ago, actually, during the COVID. Around 2020 and 2021, that was the starting point of this global pandemic. I think most of European countries and the US got stressed out about solution regarding the handling of this public health issue. And then we started to see the entrance of the international financial firms kind of ceased for a while, and we fully understand why, because the headquarters perhaps has better things to focus on and more stress in their home country as well. But actually started from this year, if we just take, for example, efinancialcareer.com, that was one of the headhunter websites, there are actually more job openings from international financial firms in the asset management and the banking firms. So I think I was very surprised, about the commitment and the interest of those firms who already established subsidiaries in the Chinese market. I think, we actually went through a wave of levers around 2016. The Royal Bank of Scotland left to China. Some of those firms, who justified the decision, if they actually have a stake to hold around Chinese market, I think that was a very healthy exercise for most of the international business to actually see the reason why they want to participate in Chinese market. Do they actually have capacity to service the corporates, the individuals, the rising mid class, for example? Do they actually have enough talents and a product to actually to provide? Do they actually have a competitive advantage to cast in the Chinese market? That actually gave us a lot of questions to think about. So as a result, this year, especially we call them WFOE, the wholly foreign-owned enterprises in China, the number keep increasing. COVID did pause some of the approval procedure from the authorities. We understand that part, but we didn't see a completely freezing of the applications. I mean, the international participants are still very interested. They are still very optimistic about the future economic growth and the rising of the Chinese affluent cities and also rich people. So I think it's important to understand China from fundamentals perspective. First of all, is the structural change. Industry and the citizens are confronting the structural change of a personal wealth and how to drive the business towards the next level. We're not saying China or Chinese product will keep being cheap. That will not be the sign, because one of the common goal China is confronting is getting old before getting rich. The Chinese population around 2050 will be 40% around retirement. So the question is really about how to keep this country going. That's a common interest of all the Chinese citizens and the government. So to the international financial firms who are still committed to participate in the Chinese market now, are very much attracted about the changing landscape from the industry's perspective, because they're upgrading the service and production. From the sector's perspective, there's been new policies to allow the private pension scheme to be launched to asset managers, to some of the bankers. Those are the fruits, bread and the butter to participate. So attraction is still there.
Just to remind the audience, we have a harder stop today, an earlier hard stop at 5 minutes before the hour. So I won't go through all the questions, but there are a couple of comments. There's an interesting comment from Ling Liu in relation to what we just asked Jörg. What's the percentage now that European companies sell their final goods to their home country? The figures in 2000 indicated that around 50% of exporting from China was made by foreign investors. I think I'd want to check that data point, but it's a sort of data point we do need to look at, especially in terms of trade imbalances, because obviously if we're looking at supply chains, how many finished goods from foreign companies are made in China and then exported from China? That's a tricky set of data to explore, with supply chains being so complex. But I think also, Yang, you mentioned another very interesting data point: the number of WOFEs, wholly foreign-owned enterprises, being registered in China. Very interesting to hear that it's increased. That's a sort of data that I think we need to look at more carefully as well. And perhaps I can just use that as an introduction to, probably it's coming up to closing question for both of you, starting with Jörg. Looking at those data points, looking at the challenges for supply chains, looking at the confidence levels from Western businesses, not just in the political issues, but in the uncertainty. It's risk, right? That's what investment is based on, largely risk. Is there a danger of increased decoupling? And I wouldn't call decoupling an event. I think it's more a process economically, where people look at risk and then perhaps go elsewhere in certain sectors. And I do see it as a danger. Is there a danger, perhaps Jörg, first of all, of this increasing in the next 1 to 2 years based on the political circumstances, economic circumstances, uncertainty? How do you see the outlook for that?
First, to your remark on the fact that so high percentage of exports are done by foreigners, frankly, it's mostly Hong Kong or Taiwan-based companies. It's the Foxcons of this world. My members are primarily production in China for China. We might see our chemicals in products like toys and so forth being exported, but we are not really here. Of course, there's IKEA that buys a lot of furniture in China. You have other trading companies that buy a lot of electronics in China. But the members we talk about here is primarily the real economy, and it's what stays over here. I forgot the last part of your question because I was so taken apart. What was the second? Sorry, for my age.
In light of all this data, the perceptions of risk, the uncertainty, is there a risk about decoupling increasing?
Sorry. It's particular. We have launched a paper last year in January about decoupling, the threat of decoupling. European business doesn't like decoupling. We think it's happening. It's happened certainly on the IT side. Where the Chinese system demands us to have Chinese hardware and software. So we have to protect our global system by having a different system over here. Decoupling in the sense that data transfer laws makes our research more transparent. We don't want to share our research results necessarily because that determines the fate of our companies for decades to come. So there will be a scale back on research. As I said before, the development is going to be very strong. And decoupling is happening because the inability of traveling both ways. So it's very interesting to see how our top executives are traveling across Southeast Asia. And before it was sort of given that you put all your money, most of your money into China. And now all of a sudden it's this kind of seeing is believing. Oh, Jakarta, not bad. Oh, Vietnam, very interesting, and so forth. Even India, you know, when you ask Apple, if you ask SAP and other companies, India always looked like India, meaning not really reliable. But as a matter of fact, now China doesn't look reliable. So I'm not saying we're moving out. It's just that we stay put, but we put more money elsewhere. And that's where also politics comes into the game. We really have board meetings that are determined to have more friend-shoring, meaning less political risk, less political stress, being in Xinjiang, being too many eggs in one basket in China. So nearshoring could well be Turkey, could be North Africa. We have a very strong push in some areas like semiconductors, battery materials, pharmaceutical precursors that our governments want us closer to home. And then of course shipping, the kind of excessive shipping that took place in the last 20 years is possibly coming to an end. We still have, of course, shipping after that, but there will be different kind of closer to home thinking. So I guess that also the inability of cracking the market as an export market will lead our companies to say, okay, you know, what the heck, then I'll stay home. I think there's a real shift going on to actually and not go away from China, just to emphasize China less than before. And again, it's in China's power in order to undo this and shine and sparkle again. But I see no efforts, frankly. The vaccination rate is low. Ideology is super nationalistic. You always have the threat of Taiwan dangling over your head. You have appalling conditions in Xinjiang. So in boardrooms where we used to discuss the market and how to put more money in there, all of a sudden we have risk assessments to do. And again, there are companies like my own that have a huge investment profile in China already now. We have a $10 billion project going on in Guangdong. We have another up our sleeves. So in a way, for chemicals, it's absolutely a non-brainer. You have to be in China. But in other segments, it might not be the case. There might be choices elsewhere.
It's a very good point. Obviously, decoupling is not an event. It's a series of risk assessments by companies. Yeah. Yang, how do you see this from Beijing and the risk of it, and how you can, well, probably how you would wish to lessen decoupling?
Well, there are actually several things I would tend to agree with you, to be honest. I think it is an eventual procedure and it takes the steps. I think that's a price that China would have to pay if they tend to walk out of this mid-income trap. For a nation to develop and reach a reasonably well stage, they have to drop the idea just for the labor-intensive industry and being offering the cheap products. So I guess, you know, with so few waves of industries, you know, who've been suffering from those reforms. In the past, it was the export industry who's providing Christmas trees, for example. And then we started to understand some of the segments or parts producers might like to move to Vietnam, and some of the Southeast Asian countries have been performing really well. And i.e., from fund industry, we also allocated a new strategy around that as a collective action. So you can actually see where money moves following the economic growth and a new focus in Asia. So I think we wouldn't call that decoupling. I would think it's a natural development of a country. You know, we wouldn't want to see any country remain poor and a poverty in this country. I think there's a common goal to make our world better and richer. But China would really have to deliver more detailed measures during this procedure. I think it is not something that we can easily answer. It is like the same question that we would challenge our governments like back in Europe as well, and how would you handle those economic activities. But the financial industry let me point to that, do not deliver the authentic value of the national performance. We provide service. The fundamental is relays in the hand of the true entrepreneurs who drives this country from different sectors. They put seed in the soil, they manufacture things, who add value into those production. We still need to go back to the very authentic way of producing things. However, nowadays, financial sector itself stays as a significant part in the Chinese stock market, represent a lot of people's interest during the downturn. They would put money in the banks, in the financial sectors. I think that is wrong. The financial sector itself should follow the movement of the industry, not to represent itself, because there's so much gray areas we could point to and to blame them. We saw that in US about the mortgage issue. We saw that in UK as well. That's why the FCA reformed as well. So, would China develop towards a better world? I think, I would hope so. Would globalization still make China profitable in terms of its development? I think that's what China wants. And that's why China keep emphasizing that on the Davos or different kind of international scope. Would geopolitics to play stronger view? I hope it will decrease, because once the Western country actually puts more interest to understand, we can no longer extract more a marginal benefit from China. Let's focus on some other countries. I think that's how a developed state to keep developing its economy. I think the world will not change dramatically, but you have to allow some country to move up into the new ladders. That's the principle.
It's changing quickly. It's obviously being changed, driven by events such as the pandemic and the war in Ukraine. And Roddy, I think one of your favourite quotes is from Prime Minister Macmillan in the UK of what sort of thing worries him most, which is events, dear boy, events. So the same for all of us in looking at the outlook for China. Events probably should worry us more than anything. And Roddy, with that, could I hand back to you to close, please?
Of course, thank you, Martin. And talking of events, this has been a very interesting one. When people come to look at the recording and unpack all of the comments that Jörg, you and Yang, you have made, I know they will find it fascinating. And amongst the comments, I've seen one from George Magnus, who is always interesting, just saying that he thinks there's something sinister about the zero COVID that transcends public health issues and is very much about the politics in China, in which a more state-centric, repressive and self-reliant China is disengaging and so on, but his comments are there. But in conclusion, and mindful of Jörg's time today, thank you, both of you, very much for your comments. We had quite a large number of people following this event, and I'm sure there'll be a lot of comment, but you've highlighted the challenges, you pointed to ways forward, and you have certainly educated us during this session. So on behalf of the Asia Scotland Institute, thank you very much indeed.